What's up, guys, and welcome to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. If you've been paying attention to the markets this past week, you would have noticed some pretty wild declines in certain stocks that on the surface is hard to make sense of. Discovery Communications, Viacom CBS, as well as Chinese companies including Tencent Music and Vipshop all declined 30 to 50% over the past week. These stocks have no fundamental connection and don't even operate in the same markets, so you wouldn't normally expect them to be so highly correlated to the downside. It turns out that these declines were driven by one large institutional investor that was forced to liquidate its holdings after its portfolio blew up. On March 26th, Bloomberg reported that Goldman Sachs, Morgan Stanley, and other institutional brokers were selling large blocks of certain stocks worth billions of dollars each, pushing their prices down. The distressed hedge fund in question was Archegos Capital Management, run by South Korean billionaire Bill Hwang. Before we get into the video, make sure you smash that like button for the YouTube algorithm. As reported by Chinese news outlet Haixun, Archegos Capital had as much as $15 billion of equity, but also used leverage to the tune of 3 to 4 times, so their gross assets under control could have been well over $30 billion. They employed a long-short strategy where they sell shares short and use this money to fund their long positions. This allows them to make a lot of money if the market moves favorably, and is theoretically a safe strategy because their long and short positions hedge each other, reducing their exposure to the movements in the overall market. However, if their long positions decline in value by more than their short positions, this puts them in a very precarious situation, because they will not have enough money to cover their shorts. When the hedge fund's broker thinks this is about to happen, they will initiate a margin call and forcibly liquidate all of the hedge fund's positions in an effort to stop the bleeding. This is exactly what happened to Archegos. They had large long positions in US media company Viacom CBS, as well as Fodcore Technology, which is a direct Chinese translation of RLX Technologies, a Chinese electronic cigarette company. They also owned a stake in Chinese online education company GSX. Viacom stock has been a big winner in 2021, with the share price gaining 175% and reaching a high of $100. Viacom's management decided to take advantage of the elevated share price and announced plans to issue $3 billion in new shares. This caused the stock to plummet as investors feared the dilutive effect of the share issue. At around the same time, RLX stock tanked 50% in one day as the Chinese government signaled that they would start regulating the vaping industry more aggressively. But the trouble didn't end there. GSX stock also started to tank on the news that the Chinese government was planning to increase regulations on the online education industry. Archegos' brokers, including Goldman Sachs and Morgan Stanley, saw what was going on and feared that in light of these new losses, Archegos may not have enough money to cover its shorts. So they took control of the hedge fund's portfolio and started liquidating tens of billions of dollars worth of positions, causing the prices to tank. This sell-off impacted all of the stocks in the hedge fund's portfolio. That's why you had stocks like Discovery Communications and Tencent Music tanking, despite the fact that there is no fundamental bad news about these companies. Their share prices were just being pushed down for technical reasons. Archegos Capital has a history that dates back to the early 2000s and 2010s. It was originally known as Tiger Asia Management and was run by founder Bill Hwang. It was founded in 2001 when it immediately started posting huge returns for its investors. Through 2007, it posted an annual rate of return of 40%. Unfortunately, those gains may not have been achieved through the traditional means of legitimate hedge funds. In April of 2010, the Hong Kong Securities Regulatory Commission sought a court order to prohibit Tiger Asia from trading in the Hong Kong markets. The concern centered around suspected insider trading in the stock of China Construction Bank Corporation from 2009. These concerns ended up in Tiger Asia admitting to the Hong Kong Securities Regulatory Commission that its trading from December of 2008 to January 2009 did indeed violate Hong Kong's insider trading laws. It also admitted that it engaged in market manipulation of the stock of China Construction Bank. Separately, but due to the same insider trading scandal, in late 2012, the SEC also charged Bill Hwang with insider trading and gave details about the scheme in a press release. Bill Hwang and his hedge funds were based in the US, so they are subject to US jurisdiction. The SEC said that on behalf of two of his hedge funds, Tiger Asia Management and Tiger Asia Partners, Bill Hwang committed insider trading by shorting 3 Chinese bank stocks based on confidential information. They had received this information when they were offered private placements in the companies. They made an arbitrage by shorting the stocks at the spot price and then covering the shorts at a price they were offered in the private placement offerings, despite conditions of the offerings that they were not allowed to trade in the stock before the offering executed. Additionally, they engaged in market manipulation by deliberately placing losing and market-depressing trades in certain Chinese bank stocks, while they simultaneously held large short positions in those stocks. These schemes allowed Huang to illegally collect inflated fees from their investors. These also caused the U.S. Attorney's Office in New Jersey to file parallel charges against Tiger Asia Management. According to the SEC, Bill Huang and his associates made $16.2 million from insider trading, and another $500,000 in excess illegal management fees from the market manipulation. Bill Huang, along with several of his employees, agreed to a settlement that amounted to $44 million total. Tiger Asia Management paid $16 million of it directly to criminal authorities, although no other parties either admitted to or denied the charges. After the settlement, Bill Huang announced that he would return all capital to existing shareholders and turn what remained into a family office. This is the same strategy used by the giant hedge fund SAC Capital after they were convicted of insider trading in 2013 and had to pay $1.8 billion in fines. After this, founder Steve Cohen turned the hedge fund into a family office for 4 years before rebranding it as Point72. One of Archegos' most interesting long positions was in Chinese education company GSX. GSX IPO'd in 2019 at $10 a share and increased more than tenfold to a peak of $114 a share in October of 2020. However, it has since given back most of those gains, declining 65% from the peak, with the recent underperformance in share price significantly contributing to Archegos' forced liquidation. In May of 2020, famous short-selling firm Muddy Waters published a short report accusing GSX of committing fraud and said up to 80% of its users are actually bots. Here's Muddy Waters founder and CIO Carson Block explaining the bear case for the company on CNBC.
Well, it claims to be an online education company, core business providing K through 12 education, but it doesn't really actually educate that many people. We use the company's own data, which is available to you if you pay for classes and then go into Google Chrome developer tools. You can get a downloadable zip file that shows for each class that you've registered for, shows all of the users, their IDs, their IP addresses, and their login, logout records. And when we analyzed that, we found 3 very high confidence patterns of bot behavior among these users, and a 4th that we also think makes many of the users very likely bots. But our sample was of about 54,000 users, and from that, we saw that 73% we're highly confident are bots, and another 7 and change percent very likely bots. So that would take us to a bot to reality ratio of about 80%, and it wouldn't surprise me. I mean, we were pretty company favorable in the way we looked at some of this, so it wouldn't surprise me if, in reality, fake users are more like 90%. Fake revenue should be 80 to 90+% of what they report. So the company barely exists, yet it's managed to cheat its way to an $8+ billion market cap here in the U.S.
Despite the bear case Carson Block laid out, the stock actually soared more than 300% from the time he published a short report to its peak in October 2020, likely costing Muddy Waters hundreds of millions of dollars of losses. While it's possible that Carson Block was mistaken and GSX is actually a completely legit company, there's also another potential explanation for the share price performance.
We realized things were radically different last year. I mean, we were short this near total fraud called GSX. We still are, but we were shorted in much bigger size and got squeezed way up by what was really a consortium of hedge funds who I think engineered this. So yeah, the game's been different since COVID, and we adapted last year, and I think we adapt going forward.
Carson Block thinks that a consortium of sophisticated hedge funds saw that he was short the stock and aggressively bought into the stock in an effort to induce a short squeeze. Is it possible that Archegos Capital was one of the hedge funds that Carson was talking about? Bill Huang is certainly a sophisticated investor, and it's pretty much within the realm of possibility that he was trying to induce a short squeeze. Unfortunately for him, this plan seems to have backfired recently, and the fall of GSX may have been the straw that broke the camel's back, causing his hedge fund to be liquidated. Alright guys, that wraps it up for this video. Before you go, make sure to check out our second channel, WSM Research, where we post DD videos on high-growth tech stocks. If you like this content, make sure to hit the like button for the YouTube algorithm, and subscribe so you don't miss future videos. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.